Welcome to the Pro Ticker Deep Dive. Okay, let's unpack this. For the past few years, it feels like all eyes were just glued to the Fed, right? Every speech, every dot plot, trying to guess what they'd do next.
Absolutely. Total Fed watching.
But looking at things now, I think we've got to ask a totally different question. Who's really driving the bus right now? Is it still the Fed? Or has the bond market grabbed the wheel?
Yeah, that's not just a thought experiment anymore. It seems pretty clear the bond market is firmly in control. So our mission today really is to figure out what these bond rates are telling us.
And what are they telling us?
Well, the main signal is, look out, a big rate cut cycle is coming.
Yeah.
And honestly, it's a pretty sobering message, especially when you contrast it with all the excitement, the high enthusiasm for AI and growth in the stock market.
It does create this, massive split personality for investors, doesn't it? You've got stock folks acting like it's, 1999 again, super optimistic on tech, margins, the consumer.
Right. Full steam ahead.
But then you look at the bond traders. They're behaving like it's 2008, signaling these really fast, aggressive rate cuts. It's like they're pricing in two totally different economies.
And that's the core tension right now. I mean, the real dramatic idea here is this. The Fed keeps saying it's data dependent.
We hear it all the time.
But the bond market is the data now. The yields themselves reflect the market's collective bet on the future. They're not waiting for the Fed's opinion. They're pricing it in already. And that price action is screaming one thing. Big cuts are coming soon.
And those screams, historically speaking, they usually mean something serious is going on. This isn't just background noise. It's a pattern, right? An historical warning.
Oh, absolutely. It's backed by decades of history.
Yeah.
The expectation embedded in futures markets right now is, well, it's intense. They're pricing in a full percentage point cut that's 100 basis points over just the next 6 months.
A full point in 6 months. Wow. How does that stack up historically?
It's aggressive. We look back all the way to 1955. And in that time, the Fed has dropped rates by at least that much, 100 basis points in 6 months, only 12 times.
12 times since 1955. Okay. And the big question, what happened after those cuts?
Yeah, here's the kicker. Out of those 12 times, only twice did that kind of rapid cutting cycle not happen alongside a recession.
Only twice. So you're saying there's, less than a 20% chance of dodging a recession if the bond market is right?
Based on that historical pattern, yes. It's a tough statistic to argue with. A very high bar to clear if you think this time is different.
That's a number you can't ignore it. It kind of forces you to rethink how you interpret Fed cuts, doesn't it? Like, normally we think, oh, great, cuts, stimulus, stocks go up.
That's the old playbook, yeah. But the worry now is that these cuts, especially if they're this aggressive, aren't coming because things are great. They're coming because the economy's already shaky.
So it's not a celebration, it's a reaction.
Exactly. It's a reaction to weakness, to slowing, maybe instability the Fed's trying to head off.
Yeah.
So that whole good news is good news idea flips. Suddenly, it's, uh-oh, rate cuts mean trouble might already be here. The reason for the cuts totally changes how the market feels about them.
That shift is crucial. Okay, let's zoom out a bit from just the rate cycle. The backdrop seems to be this huge clash between two big long-term forces. Devaluation versus productivity. Can you break that down?
Yeah, this is really the big picture for setting your long-term strategy. So first you've got let's call it the defensive pressure, the devaluation cycle. This really got going around 2022, think persistent inflation, massive government deficits needing funding, geopolitical instability messing with trade.
And why should the average person listening care about devaluation?
Well, because when the value of money itself, the dollar, other currencies eroding, or the debt load gets too big, history shows capital starts shying away from traditional stocks and bonds. Equity returns tend to suffer. Money looks for safety, for hard assets, things like gold. It's basically a loss of confidence in the future purchasing power of fiat money.
So that's the headwind. What's the counterforce, the thing pushing back?
That's the engine of productivity growth. Every so often, technology delivers a real step change, something that fundamentally boosts efficiency and output, potentially strong enough to offset or even reverse that devaluation trend.
And right now, that's AI.
Right now, the big contender is AI, definitely. Plus, you've got this global push for reindustrialization, fixing supply chains. If AI really delivers the kind of productivity leaps people are talking about, it could generate enough real economic growth to maybe, just maybe, overcome the deficit and inflation issues.
Okay, so we have this. Currency weakness pushing down, technology pushing up. We can't know for sure which wins or when. So how do you navigate that? How do you invest?
The approach that makes sense is what's called the barbell strategy. It's specifically designed for this kind of uncertainty, this asymmetry. You can't really afford to bet everything on one outcome.
So balanced.
Kind of. On one end of the barbell, you need gold. That's your defense. It's the classic hedge against currency losing value, against that loss of confidence in paper money. You see central banks loading up on it too, which tells you something.
Makes sense. And the other end of the barbell.
That's your offense. That's where you need significant exposure to AI and related tech. You're aiming for what we call right-tail productivity growth.
Meaning
You're looking for that potential for massive outsized returns if the technology really transforms things. The upside could be huge, exponential even, potentially overcoming the broader economic drag.
Yeah.
So you hold both. Gold for safety against the downside, AI for a shot at that massive upside, balanced through asymmetry.
Okay, now here's where it gets really interesting for me. Because for any of this growth stuff like AI to really take hold broadly, one specific area seems critical, and it's been weak. Housing. We're seeing housing identified as this kind of silent drag on a key growth measure, the PMI, for like the last 3 years.
That's absolutely right. We often focus on, say, manufacturing PMIs, but housing has been this hidden anchor. You have to understand how the PMI works. It measures broad economic health. But when housing activity just grinds to a halt because mortgage rates are sky high.
It pulls everything else down with it.
Exactly. It's not just construction workers. When people stop buying houses or even renovating, think about it. Demand for appliances, furniture, flooring, roofing, even things like HVAC systems, it just craters.
Right, all those related industries.
And those industries feed directly into both manufacturing and the services parts of the PMI. So a housing slowdown effectively puts a chokehold on a huge swath of the economy, pulling that overall growth index down. We're seeing that clearly now demand for new homes is weak, mortgage applications are down, even those HVAC sales are sluggish.
So the bottom line is, for the wider economy, for that PMI number to really get going again, housing has to stabilize first.
Pretty much. Mortgage demand, housing activity, they need to find a floor and start recovering. Without that foundation, Fed rate cuts might just be, kicking the can down the road. They might delay the pain, but not necessarily reverse a slowdown.
Housing stability is the key prerequisite. Got it. Okay, let's pivot to opportunities. Even with these tensions, the rate cut warnings, the housing drag, there must be areas to focus on. Let's start with the offense, that AI investment cycle.
Yet what's really striking is how durable that AI spending seems to be. Even with all this recession talk, the hyperscalers, the big cloud companies like Microsoft, Amazon, Google, they keep raising their spending plans, their CapEx budgets, quarter after quarter.
They're still building out.
Oh, yeah. They're in an arms race to build the infrastructure for AI. It's a massive cycle, and it doesn't seem like it's stopping easily.
But we hear constantly about AI valuations being stretched. Is this cycle maybe getting long in the tooth, or is there still room to run?
That's a fair question. One way to get perspective is to look at tech investment relative to the whole economy as a percentage of GDP. Right now, it's only about 2%.
Okay, 2%. And what was it like, say, during the dot-com boom?
At the peak back then, in the late 90s, tech investment hit closer to 3% of GDP.
Ah, so that gap, that 1% difference.
That represents potentially trillions in future investment. It suggests that, despite the hype and the concentration in a few names, the underlying structural trend for AI investment still has a long way to go. We're likely still in the earlier innings.
That's a helpful metric. Okay, opportunity number 2 sounds a bit more technical. Financials and the yield curve steepening.
Right, this is a classic pattern linked to rate cuts. When the Fed starts cutting rates aggressively, especially short-term rates, it usually causes the yield curve to steepen.
Meaning the gap widens between short-term rates and long-term rates.
Exactly. Short-term yields fall faster because the Fed controls those, while long-term yields, driven more by market growth and inflation expectations, might fall less or even rise. And this widening gap is really important for banks.
Why is that spread so critical for banks?
Well, think about their basic business model. They borrow short-term, like from depositors, paying low short-term rates, and they lend long-term, like mortgages, business loans, at higher long-term rates. Their profit margin is basically that spread.
So a steep curve means fatter margins.
Precisely. When the curve is flat, or even inverted like it has been, their margins get squeezed badly. But when it steepens long rates, much higher than short rates, that's like a green light for bank profitability.
And how much potential steepening are we talking about?
Well, if you look historically, during a recovery or after a cutting cycle, that spread between the 2-year yield and the 10-year yield often gets up towards, say, 200 basis points, 2 full percentage points.
So where are we now?
Right now, it's only around maybe 50 basis points. So there's potentially another 150 basis points of widening possible if things normalize. That's a huge potential tailwind for the financial sector, totally separate from AI.
Okay, that's clear. And opportunity number 3 is our old friend, the defense, gold.
Yep, gold. We keep coming back to it because it remains the necessary protector. As long as that devaluation risk is out there, with deficits growing, gold is just the cleanest, most direct hedge against losing faith in fiat currencies. It's the essential defensive part of the barbell.
All right, let's pour some cold water now. What are the biggest risks we need to keep front and center?
Risk number one is simply ignoring history. That statistic, we talked about the 100 basis point cut cycle, only avoiding recession twice since 1955. That's the biggest risk. Betting against those odds, assuming this time is different when history suggests otherwise.
Don't fight history, just like don't fight the bond market. Okay, what's risk number 2?
That's tied to how the stock market looks right now. Its narrowness and its dependence on just a few drivers.
You mean the concentration in AI?
Yeah. Leadership is incredibly narrow. It's basically a handful of massive AI-related stocks in tech and communication services holding things up. For the market to broaden out healthily, we need rotations in cyclical sectors, industrials, materials, energy, financials, the stuff that does well when the whole economy improves.
And what needs to happen for that rotation?
Well, typically you need long-term rates like the 10-year yield to come down more significantly, maybe closer to 3%, to signal that broader stability and take pressure off those sectors. Until then, traders are watching key S&P 500 levels really closely. Feels like 4,800 to 4,900 is the floor people are defending.
But struggling to get past.
Struggling to break and hold above 5,200. That level seems to be pretty strong resistance. If we can't clear that soon, the risk is we retest that lower 4,800, 4,900 zone pretty quickly.
Okay, so let's try to synthesize all this. What does it all mean? If we boil down this deep dive on rates, housing, AI, the whole picture, what's the main takeaway, the golden rule?
I think the golden rule hasn't changed, and it's clearer than ever. Do not fight the bond market. Forget the noise for a second. The yields are the real signal. And right now, they're flashing warning signs. Rapid cuts are coming, and that usually implies trouble. So vigilance is key.
And given that warning, but also the AI opportunity, what's the mandate for investors trying to navigate this?
The mandate really has to be balance. You need to run that barbell strategy. You absolutely need offense, significant exposure to AI, because that structural growth story is powerful and likely still early.
But you also need...
You absolutely need defense. Keep that gold allocation as protection against the ongoing devaluation pressures. And maybe most importantly right now, watch housing data like a hawk. Treat it like it's the most critical data point out there because it really holds the key to whether the broader economy can genuinely reaccelerate. You know, the market right now is just caught in this really fascinating, really delicate tug of war. It's devaluation versus productivity. It's fear of cuts versus FOMO on growth. It's recession risk versus AI promise. It just demands that you stay diversified, stay nimble, and always remember who's really steering the ship right now, and that seems to be the bond market.
See you all on the next Pro Ticker Deep Dive.